Hello, I'm Lucky, your TA for the day. I want to shake your hand for making it this far through the class. This next set of lectures are on adjusting journal entries. To make it easy to learn, Professor Lavada separated them into 4 shorter videos. It also made it easier for her to edit. In addition, she is not chewing gum throughout these videos. She mistakenly put the keyboard a little too close to the microphone, and that's the smacking noise you'll hear throughout. Adjusting journal entries tend to be the hardest thing for students to understand. Listen carefully and practice, 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 and you'll have it conquered by the exam. Good luck, and see you later.
For chapter 3, there's a lot of journal entries, so I'm going to try that using Excel. The adjusting process is something you have to do at the end of a particular period, because while we make our journal entries as each transaction occurs, at the end of the period, some things aren't exactly right, because we want to make sure that what we did in 2020 shows up in 2020. What we do in 2021 shows up in 2021. So we want to make sure that all our assets are right, all our liabilities are right as of December 31st, and for the income statement over a period. So that's what we're doing in this chapter. To date, we assumed a company began on January 1. On December 31, you closed up shop, you went home, and you went out of business. Hopefully that's not the company that you're working in or that you've started. So we've got something called the going concern principle. And that means that in accounting, we assume your company will go for multiple years. And the reason that's important is if you think you're going to go out of business next year, then all your loans come due, even if you have a 5-year loan. Let's say you're going to have to pay off as much as you can on that car next year. So we don't have any long-term assets. We don't have a going concern principle. We don't have any long-term liabilities. Everything would come due at the end of the next year, or maybe even this year. So that's our going concern principle. At the end of the period, we need to update our records to show what happened in that period. And I use the word period because sometimes that's going to be a month, sometimes it will be a quarter, but it will always be at year end. Some people do adjusting journal entries at the end of every month, so they know what happened in January versus February. A lot of companies will do it quarterly, so they can kind of compare this quarter to last quarter. But always, all companies have to do adjusting entries at the end of the year to make sure 2020 is different from 2021. We always need to know what we did in a particular year. The reason it's important is, again, the balance sheet is just a snapshot of what the company, what the word has, on a particular date. So just like you take a snapshot of your family this past Christmas, when we look at it next Christmas, it's going to look very different. Our people will have grown, both up and out perhaps. You might have new additions to the family, all sorts of things will change. So that balance sheet is just what do you have on a particular date. For our purposes, year end will always be December 31st. And that's just to make our problems easy. If I say December 31st, that's year end. In real life, some companies have fiscal year ends in June. Walmart and retailers will have fiscal year end usually in February because they don't want to be worried about figuring things out between Christmas and New Year's when everybody's returning stuff. In our problems, it's always December 31st. And our snapshot is even at the end of the day on December 31st. So what do you have at 11:59 on December 31st before the ball drops? That's what we're going to say is on your balance sheet. So if we think about, your cash, for example, that changes every time you write a check throughout the day. We need to kind of have a stop point that we want all the checks that have cleared again by December 31st. If we hasn't cleared, it doesn't go on this year's as either a deposit or a withdrawal. Accounts receivable changes as well. Those are the easiest ones to think about because, again, those also, if I collect the cash, it's cash. If I haven't collected it yet, it's accounts receivable. So whatever happens by December 31st is what's going to show up. We've got the same problem. So remember, these are all our assets. We've got the same issues with our liabilities. You want what you owe, as of December 31st is what's going to show up in your liabilities. So you can manipulate a little bit. If you want a little more cash and a little more liabilities, you can wait to pay your off on January. You're going to have a little bit more cash, but your liability balance is going to be high. If you want your liabilities to go down a little bit and you don't mind your cash going down, you pay it off in December, and that's going to make a difference in what you show on that balance sheet. Holders' equity doesn't usually move too much other than retained earnings. It all gets impacted by the income statement. The income statement, while the balance sheet is a snapshot, the income statement is for a period of time. There's a start date and a stop date. So when you look at your income statement, it will say for, like January 1 to December 31. We need to know what happened during that period of time. Because of that, sometimes people say the income statement is a flow. It's like watching the river go by, how much water has gone over the dam that particular period. For a balance sheet, we call that a stock because that's what you kind of got in stock on a particular day. So if you ever hear those terms, that's all it's saying. One's for a period of time, one's for one point in time. For our income statement, again, we want the expenses, so what we use this period. Yearly, it can be quarterly, it can be monthly. What did you use? And I've got this upside down, but the revenues is what you did as far as sales, and if you're a service company, what did you actually do this period? So we have to get everything in the right place. And what our adjusting journal entries do, we'll move things between the income statement and the balance sheet to make sure that they're on the right financial statement at a particular period. So we've talked about the revenue recognition principle before when we talked about accrual accounting. Revenue recognition says we recognize revenue when it's earned. And again, earned is when you kind of performed the service or kind of when the goods are delivered. For expenses, recognize the expenses as incurred. And by incurred, we mean you use it, whatever the it is. I guess the it's what should be in quotes, but when you use it, so when do I use the utilities? When do I use my employees' labor? But there's a little or. Some things are a little kind of hard to see that you've used it. You can match with the associated revenue. If I have revenue, I want the expenses below here to be in the same period as the revenue associated with those. The easiest thing to understand on that side would be like cost of goods sold. The cost of goods sold, recognize that is sold. So if I buy those guitars, I recognize inventory when I buy them. When I sell the guitar, then I have the revenue, and then I want the cost of goods sold to be right next to it. I want it to be in the same period. So if you can't figure out when you use it, if we can put it in the same period as revenue, that is our kind of second best choice. So what that means is we had this little accounting cycle before. Now we got a couple more things. Before we had journal entries, we posted, we did a trial balance. We did all that in the prior chapter with Pharrell. Then we did our financial statements. Well, we were really a little premature on those financial statements because we first have to do some adjusting journal entries. And then we'll actually post these to the ledger as well, but we don't usually fix that as a step because it's so simple. And then we do an adjusted trial balance to make sure our debits still equal our credits. And that's how we get our financial statements. And we'll do the actual adjusting journal entries in the next video.